Hi, everyone, and welcome to another episode of Investing Strategies. We're seeing a huge surge in retail trading this year, and we sat down with the poster child of this movement, Dave Portnoy of Barstool Sports. Some say he's inspiring a new generation of traders to get involved in the market, and he sure is having some fun along the way. And for those who are just beginning their investing journey, IBD's own Mike Webster breaks down some key investing rules to help speed up your learning curve. It also serves as a great reminder for more experienced traders out there too. Plus, the ongoing race for coronavirus vaccine means the medical sector continues to demand attention. But the technological innovations in healthcare extend well beyond the pandemic efforts. Deka with ROBO Global sheds light on the latest. Investing Strategies starts right now. Well, there are very few people trending more right now in the trading world than Barstool Sports founder Dave Portnoy. He's taking the stock market by storm and having some fun along the way. Joining us now is Davey Day Trader himself. Dave, thanks so much for joining us today.
Thanks for having me.
You've not been shy to point out the so-called Wall Street establishment not taking you very seriously, calling you and your followers things like willfully ignorant, saying you're just gambling and that you're going to get humbled. But we've also had, at the same time, this elimination of commissions, no sports for a couple of months, and a lot of people being forced to stay inside because of the pandemic. And many are crediting you with the huge boost in retail trading we've seen this year. Do you think that this movement that you've been leading would even be happening if you weren't so enthusiastic and outspoken about what you've been doing?
You know, I think it's kind of a self-fulfilling prophecy, because if I was just doing this in my own bubble and the financial community didn't kind of latch onto it and start making me headline news literally every single day, and if you turn on, Fox Business or CNBC, they're talking about me every single day, so more people are finding out, it kind of became a snowball, going downhill. So I think I would have had an effect. I don't actually know how big of an effect I have. It's hard to tell smoke and mirrors. It seems like everything that the financial community can't explain, they blame on me. And whenever the stock market is down, they're like, see, he has no effect. So I really can't tell. I don't know how much of an effect I'm having. I just know a lot of people are talking about me.
Yeah. And even though you have bought stocks that you've said you've no idea what the company does, like recent IPO Lemonade, for example, does that just underscore the level of bullishness that you have about this market in general? Or are you just having fun with those kinds of trades?
Well, no, I'm bullish. I mean, so when I first got involved in the stock market, I was shorting stocks and I was looking at the world and being like, I don't know how things can go up. And I was getting murdered. And then I came to the conclusion or assumption at some point, the stock market was fairly disconnected from the real world, or maybe it just hit the lows. And since I basically adopted the mantra of stocks only go up, I do believe all stocks go up. There's very few. As far as buying like Lemonade, which was a mistake, I think, I don't know how I got that one, or stocks that I actually don't know what they are. When I stream live, we have a live comment section or board, and I pay pretty close attention to what those people are saying. Now, for whatever the motives may be, whether they're trying to pump up their own stocks or whether these are the stocks that are already being talked about, they've had a pretty good hit rate when one or two stocks pop that multiple people are saying, hey, buy Novin, buy whatever it may be. I may not know what it is. I look into it, but I do listen to them because they've been pretty good. Like the stocks that they're mentioning, whether I know them, whether they're penny stocks, whatever they may be, the hit rate, the money that's been made there has been very good. Now, I don't like Amazon right now. I have $3.5 million of my own money in that one. Like the smaller stocks, I'll never do more than 150 or 200 grand. They're smaller plays and they're super volatile, but they've been right a lot more than they've been wrong.
All right. Well, as you've been alluding to, you've been dabbling in some day trading, calling yourself Davey Day Trader, but you're doing more than that. So could you walk us through your most successful trade that you've had thus far?
So yeah, it had to be the airlines. And this is kind of what launched the entire Davey Day Trader movement. Is when I was losing and I was shorting stocks, I decided at one point, I think I said I'm going to just buy the most depressed things I can find. At the time, there were airlines. So I think I bought Spirit at like $7, and I went on a big soliloquy and rant, like, the airlines are coming back, we fly in this country. And I did that rant, and maybe 10 minutes later, Warren Buffett came out and said Berkshire Hathaway is out of the airlines. So it literally, I did my thing saying go all in on the airlines. 5 minutes later, Warren Buffett said, I'm out on the airlines. And from that moment, the airlines basically skyrocketed. I think I sold a decent amount of Spirit at 21. So it went from 7 to 21 pretty quickly. And I started, grabbing on that, being like, look, I'm smarter than Warren Buffett. He's done. And that quote got taken from my stream and went everywhere. And then I just started beating it. And the other old school investors, they all started basically being like, how can you call out Warren Buffett? Well, since I've been trading, which has been about March 23rd, my portfolio is up like a bazillion%. So I'm talking about when I've been doing it. And Spirit kind of and Norwegian, those were the two big ones that I made a lot of noise about.
All right. Well, on the other side, something that's also helpful for investors. I mean, you mentioned at first you were shorting stocks and you kind of pivoted your strategy. Learning from mistakes is important. So what has been your worst trade that you've made in this trading endeavor?
So there's been a couple bad ones. Boeing crushed me. And this was shorting. I was shorting Boeing, and that's kind of when I started to be like, there's no rhyme or reason, because one day Boeing would be down like 20%. The next day it would be up 30%. I couldn't get a handle on it. So I got killed on Boeing. Lululemon killed me. I was going all in on Lululemon at earnings, and I think I bought it at 200. They beat earnings, but the guidance, which I didn't really know much about from the CEO of Lululemon, was negative. So it went from 200 to 180. I panicked and sold it. I think was up over 300 now, Lululemon. So I missed that entire ride. The CEO of Lululemon did me no favors, because like 2 days after the guidance, he reversed course and basically said, we'll be fine. And that's when it started going up. That also is when I started my, stocks only go up. I also got killed on Amazon's earnings, which are coming up again. That again was due to bad guidance from Bezos. And again, they went back up. So I panicked and sold it. So as much as people want to be like, he's just saying stocks go up, since I've been doing it, if I didn't sell anything, I'd always be in a better place, because everything has eventually gone up. I mean, Penn, which is a company that bought Barstool, that was at $4. It's at 33 right now. So yeah, stock always go up. That's been the mantra for me.
So has your strategy, now that earnings season is back, has your strategy changed? You said you have a lot in Amazon, Shopify as well. What are you going to do if those stocks drop on earnings? Are you going to sell again, or are you going to try to hold and wait for a bounce?
Yeah, that's $1 million question. I don't even know that I'm going to hold them into earnings. Earnings, I readily admit, I can't figure out, because it's seemingly you can crush earnings, have good guidance, and the stock still goes down. Or you can miss earnings, have bad guidance, it goes up. So the earnings is one thing I've not wrapped my head around at all. I think Amazon is going to have great earnings, and I think the guidance will be good, but I just don't know. I haven't decided whether I'm going to sell right before earnings call, or if I keep it, I'm not selling it. It's just whether I sell before earnings.
Got it. Well, in addition to stocks like Amazon and Shopify, you've also talked about other high quality growth stocks like Tesla, even Domino's Pizza. But you are also dabbling in, let's just call them some of those cruddier stocks. Maybe those are smaller positions, but why not just focus on those high quality growth names?
Well, it's simple. If you can get on the right side to one of these little guys, this is where it is like a gambling game. They're up like 30%, like what, Novin, NLVN, that was up 80%. I think on Thursday, it was down like 30% the day after. And last time I saw it today, it was up like 20. So those wild swings, for the most part, are not happening on the blue chip stocks, the more well-named. The lower ones right now, it's crazy. It's literally like going to a casino, but the casino's very hot. So I continue to do that because there's money to be made. Those are the stocks I'm not holding long-term at all. Like if I get a 30% bump, a 50% bump, I'll buy, I'll sell, I'll be out of that. So that's why I'm involved in those.
And what if one moves against you, like Remark? That had a big gap down not too long ago. What's kind of your line in the sand? If I'm, down 10%, I'm out. What are kind of
no
your
line in the
there?
sand? I won't sell something that's going down right now. I call Mark the woke, the worst of all time. That stock has continued to go down, still down. But even Mark will have the day like it did the other day when it'll jump 10, 15%. So that one's been that. Like I said, on my stream, they know if I say the woke, I am referring to Mark. But I still have it. I'm waiting for it to come back, and I think it will. Just when, I don't know. Because it did do that. Like Mark missed earnings and I got smoked, and then it comes back. So right now, everything eventually still has come back.
Gotcha. And how often are you looking at charts or dissecting those? Because you kind of seem more of like the big picture kind of guy who, you're thinking about the story aspect or just looking at the numbers like with the penny stocks and the big potential there.
So what's a chart? that should give you the answer to that. I don't look at the charts.
Okay, good to know. Then you're focusing on the numbers and for the bigger names like the stories.
Yeah, the numbers, the names. I'll read some articles prior to earning, what they do, like what the whispers are. Is it a COVID stock? Is it not a COVID stock? Things like that. But charts, people keep sending me, look at this inverted V or what. I don't know what the hell they're talking about when they say that. The charts look like mumbo jumbo to me.
Do you think, though, as it seems like you are becoming a more serious trader, you've said in the recent past that this is, one of the most lucrative ventures you've ever undertaken. Is that something that you might be interested in doing in order to, kind of up your game and improve your skills as a trader?
No, I have no interest. I mean, I'm interested in the company, the people running the company and what they do in the future. Charts, like I'll look at what's their 52-week high or low, where am I buying it at? I don't, if that counts as a chart, great. I think there's a lot more to it. Like I see all these space program looking things. I won't do that. But if I believe in a company, then that's more of a long term. Like I do have, besides the day trading, I do have my own personal account, which I just have stocks I'm not buying and trading. Like I have a PayPal, I have an Amazon and things like that in there that are more long-term, investments.
Gotcha. Well, speaking of the long term, something you've said is once sports are back in full force, that you would go back to sports gambling. Now, do you feel like you've kind of gotten bit by the investing bug? Say, one day the pandemic's over, everything is, with sports is back to normal. Will you still be devoting some time to investing like you are now?
Yeah, I don't know. It's really hard. So my life is generally pretty busy when we're not in quarantine and life and everything is going 24/7. We just did a big deal Barstool did with Penn, and there's a lot of plans we have for that to get their gambling app off the ground. So I'm gonna be traveling a lot, working a lot on that. I'd like to, but I don't know how much time I'll have to afford to it.
Now, there's one school of thought out there that says with so many people now off of the sidelines and in the market and, quote unquote, pushing around these penny stocks that we're in a bubble. But there's another school of thought that recognizes that the stock market is one of the greatest systems ever created for generating wealth. And we have nearly half of adults that aren't even saving for retirement. So what say you about that?
I don't think we're in a bubble. I mean, long-term stock market always goes up. One of the things that I've been saying as well, you hear a lot of these previously very successful investors, whether it be the Howard Marks or I think the Copenrath dude, whatever his name is, being like, I've been through this before, and this is a bubble that reminds me of 1987 or whatever it may be. The facts are, I have as much experience in this market as do those guys. There has never been a worldwide pandemic like this that has caused what it did with the stock market. So I think it'll continue. I think the stock market can continue to go up, but it's hard to predict. I mean, the only thing we generally have, if you look long term, stocks always do go up. So if you're in it and you don't have to take your money out anytime soon because you're not retiring or need it, if you hold tight long term, you'll be fine. I believe that. What happens when we are back to normal? I mean, I think it's still a lot of ways to go up. And by the way, the bubble people have been saying this is going to end in tears and I'm wrong. And what am I going to do when all the people who follow me lose money? They have literally been saying that every day for 4 months now. So, I mean, unless an asteroid hits the world, people will end up above where they started. They've been following me for 4 months because they're so far above where we got in. Even if you go down, like Penn today is down 7%, it's at 33. Guess what? It was at 4. So, I mean, at some point, you can't just say he's going to be wrong. It's going to end in tears for 4 months straight. And if it happens 8 months straight later, be like, I told you. And I know they will. That's what they will say. If the stock market has 3 or 4 bad days, they think, aha, Portnoy is wrong. It's like, no. You've been wrong for 4 months.
Yeah, well, there are those out there who are saying you got lucky to get in at the right time with this unprecedented rally, but you've had the conviction to stay in And not everyone on Wall Street can say the same. So thanks so much for your time today, Dave. We really appreciate it.
Thanks for having me. I had fun.
And coming up next, IBD's own Mike Webster breaks down some key investing rules for beginner traders to help you maximize your gains and minimize your losses. We'll be right back.
I'm Arusha Pierce, and welcome to Investing with IBD. Every week, we are going to give listeners insight on how the market is doing. We'll identify stocks or ETFs that are worth considering and adding to your watch list. Not only do we have investing experts, we like to bring on business leaders. The response from listeners has been amazing. It really feels like we're building this community. Join me every week as we take on the market. Listen and subscribe wherever you get your podcasts.
With the surge in retail brokerage account openings this year, there are a lot of traders out there that are just starting their investing journeys. So we wanted to take a few minutes to go over some trading tips for beginners to help speed up that learning curve. And joining me now to do just that is IBD's own Mike Webster, our head market strategist. Thanks for being here today, Mike.
Hey, thanks for having me.
All right, so the rally that we've seen after that coronavirus crash has been pretty incredible, right? A very fast recovery and a lot of stocks that are making huge moves and have done so over the past couple of months. But it's important for beginners to know that the market doesn't always act like how it's been acting as of late, right?
Well, this is a crazy time, and it is very unique. And if you look back in history over the last 100 years, there's only a few times where we've seen something like this. You had 1928 and 1929. You had a move like this in 1958, and you fast forward through time. 1998 and 1999 is the one that everyone talks about, and there's a few other isolated cases, 1980 and 1981. But this is unique, and the market, I wish it always went up, but it doesn't. And so you want to trade with the trend. And right now, the trend is clearly up, but you need to know what to look for when that breaks. So you want to focus on just simple things like moving averages. Use a shorter term moving average, like a 21-day moving average. That's your first line of defense. If we start trending under that or even breaking below that, you want to ease off the gas pedal. And if we go through the 50-day, then you want to start putting on the brakes. And if we come all the way down to the 200-day, well, that market isn't going up anymore for a while. So, it's as simple as that, really. There's a lot of nuances that we get into, but if you could just look at your 21-day, your 50-day, and your 200-day, and you keep that gas pedal on when you're above the 21-day, but then you start easing off as it starts breaking those longer term trends.
So just like timing the market is key, timing your buys, well, that is also key, of course. And if you're just buying a stock because you like the company and you're not looking at a stock chart, well, that could cause you to buy a stock at the wrong time when the odds aren't in your favor. So how can you get the odds in your favor when you're buying a stock?
Look, there's a precise time that you should be buying a stock, and there are lots of times where you shouldn't be. And there's just a small window of time once you learn how to read charts. And charts, are not intimidating. You just start off with the basics, and it's like anything else. The more time you spend with it, the more of the little nuances you'll pick up. But it's just simply pull up a stock chart, look at an area that it's trying to get through. Let's say it's trying to get up to $100, and every time it gets there, it backs away. Well, that's your what we call resistance, or that's your ceiling. And you'll hear words like a pivot point, but all that means is you're going through this area that it didn't go through before. That's when you're buying it. Otherwise, if you're just buying it willy-nilly anywhere else, you're just subject to just random pullback. So get that wind at your back and wait for that, what we call pivot point or buy point, and buy it there. And it doesn't take a lot of time in front of charts to get the basics. The rest of it is going to take a lifetime to get all of those fun nuances. But also start with the stock that you like. You had Dave on earlier, and he's great at that, of finding those stocks that he likes. And he's into pizza, so maybe you're looking at Papa John's, and you're looking at Domino's Pizza, and you're looking at those charts and seeing when the right time it is to buy it. And then once you buy it, if it goes down, let's say you buy a stock at $100, if it goes down to $99, you've done something wrong, right? Your timing was off. Don't buy more ever. Never average down. And if it goes up higher, maybe you want to add a little bit more because that's a winning trade, but never put good money after bad, and never average down under any circumstance.
You mean I can't buy a stock that I really like when it goes on sale? I'm not just getting a better deal on it?
There are lots of ways in the market to make money, right? And you buying in a pullback when it's on sale, in an uptrend is a good way of trading, but buying in a downtrend, that is a recipe for just blowing up your account. So let's say it's your favorite stock, and it's well, we were just talking about Papa John. So it's been in an uptrend. So if it pulls back off of its highs into a logical area, let's say, to its 21-day moving average, and then starts moving higher, well, you can buy it there and then just have a stop under it, an area where you're going to say, you know what, I'm wrong. And we like to use 7% from whatever you paid. Some people like 5% or 10%. Find a line that works for you and a number that works for you. And just say, you know what, if it goes down that much, I'm just going to exit, and I can always buy that stock back. But yeah, you can buy stocks on sale when they're in an uptrend. And the easy way to know if a stock is in an uptrend, look at its moving average. Is it above its 200-day and above its 50-day? If it's not in an uptrend.
That's exactly right. And, speaking of selling, it can be difficult for investors, especially beginners, because there are so many emotions that can come into play, right? Like greed or pride or hope. But if you have those sell rules like you're talking about, that can help you from suffering huge losses.
Look, everyone has fear, hope, and greed. That's what makes the market go up and what makes it come down. And anybody who tells you that they are not trading with those emotions, they're either lying to you, or they don't realize that they're doing that. Now, what you want to do is reduce those emotions by having sound rules that you believe in, and so study the market, study what works. It doesn't take a lot of time. Just look at what's been working recently, and have some ideas. Say, well, I wonder if I bought it every time it came down and touched the 50-day, how would that work? Or every time it goes into new highs after it's been going sideways for 5 weeks. Just come up with your rules. We have all of our rules. We have tons of education, but it's fun to investigate and do this yourself. And then the more rules you have, you just then know what to do. Now, if you break rules, that's when the emotions start building up. But if you have a good set of rules that you believe in and you understand, and even if they're very simple, buy it right, buy it at a point that's logical, have a stop loss, and don't average down. All of a sudden, those emotions that build up every day is going to be less. And you want to have fun with this. This is a good time. Just, like Dave likes to go and bet on games. I don't know the first thing about betting on a game. I would like flip a coin and to decide, who I'd want to bet on for a football game. And so he has an edge there. With trading, we have an edge with the rules that, the firm has developed over the years.
Yeah, and that's going to show up in the results in your portfolio, right? And just like cutting losses, talk to us briefly about taking those profits on the way up, because that's also where greed can come into play. If you start making a lot of money on a trade, you don't want to give up those gains. So, you might start holding and hoping when that trade starts to move against you. If you start thinking you're in love with the stock, it's never good to marry a stock.
No, you don't want to marry. You want to like what you're trading. You don't want it to just be a symbol. So, a 4-letter symbol, a 3-letter symbol. You wanted to kind of have an idea of what the company does, have a thesis of, I think this stock is moving up because more people are going to that restaurant, or more people are using their iPhones, what have you. But then, as you're right, you want to start taking some of those chips off the table. So just think of it, if you've ever been at a craps table and the table is hot and your stack is just growing and growing and growing. Well, what I like to do is just every once in a while take a few of those chips, put it in your pocket. And then, if table gets cold, you walk away, you go to the cashier, you still have some money. So, don't let the stocks just go way up and then way back down. And a good rule of thumb is if you're up 10% or more on a stock, raise your stop loss where you're going to cut and run up to break even. So if you buy a stock at $100, it runs up to $110. Don't let it fall back to 90. If it falls back to 100, get out of that stock. You can always buy it back. And that's one thing that people should always remember. It's okay to sell because you can buy it back.
Yeah, that's definitely important. And speaking of stocks that can go up and down very quickly, penny stocks are very emblematic of that. And there can be a lure for some investors who think that if they can get a low price stock that goes from 3 to 6, that they can double their money quickly. But what kind of trap can you fall into if you're focusing on those kinds of stocks?
Yeah, and no offense to anyone who's currently trading those, but it's cheap for a reason. The big institutions that really move stocks, up and down, they're trading in the real market where, higher price stocks that are more liquid. We consider the $2 stocks, the $5 stocks, the junk pile, because they're cheap for a reason. Now, sure, they can go up from 2 to 10. They can come from 10 to 0. You're just playing with a lot of, that is really Vegas money, but it's not investing or speculating. So, a good rule of thumb, just look at stocks that are over $25 and that are trading at least 500,000 shares a day. That's going to put you in the right pond to fish in. Sure, you're going to see some stocks go from $1 to $3. That's a huge percentage gain, but you're carrying on too much risk. So $25, 500,000 shares on average, and that's going to be a quality pile to at least be picking from.
And from a risk perspective, what should investors be thinking about in terms of how much money from their portfolio they're devoting to a certain trade, and thinking about their position sizing?
That's a key aspect, and it will take years and years to really get it down right. So a good rule of thumb is just take your account and divide it into 10 chunks. So that's whether if you have $100, you're dividing it into $10 each. If you've got $100,000, you're dividing it that way. If you've got $100 million, you've probably already figured this out. So just divide it by 10 and never put more than 10% into any one stock. That way, let's say the worst case scenario happens and you have $1,000 in your account and you put $100 in one stock and it goes bankrupt overnight and it goes down to 0. Well, you still have 90% of your assets left. Whereas if you put your entire portfolio in one and something goes wrong, you've got serious problems. So just don't put yourself in a position to blow up 10% per stock. Over the years, you'll figure out how to, sometimes have a little bit more, sometimes a little bit less.
So probably one of the biggest pieces of advice that we could share would be the importance of learning from your mistakes, because we all have to go through that when we are starting our investing journey. And even you as an advanced trader, you're learning all of the time and improving and getting better and better.
Yeah, I used to do it once a year where we do this thing called a post analysis. And it's this thing you dread all year. You're going, okay, at the end of the year, I'm going to look at all my trades and figure out what I did right and what I did wrong. And sometimes the amount of time between when you made the mistake and when you're studying it is so far removed that you don't really remember all the pieces that were going on. So now I just do a little thing, at the end of each trading day, I take, 2 to 5 minutes and just think, okay, how did I do today? What did I do right? What did I do wrong? Just think, okay, what adjustments do I need to make? It's as simple as that. It doesn't have to be this huge thing. You see some big stock that you missed out on. Maybe you shouldn't have bought it. There wasn't in position to buy. And that was a good thing that you just let that one go. And so just learn every day, write down little rules, put it in your phone and just say, don't buy an extended stock, a stock that's too far out of its basing area of its area of consolidation. Don't average down. We talked about that. If you do it, just say, I know the stove is hot. I'm not going to put my hand on there. So you're always learning. And just think about it. It's just like, an athlete is learning. A football team, they're going to sit and study their plays and how they did. And when they did it a certain way, what was the outcome versus something else. And so we're doing the same thing in the market. And you are going to make mistakes every day of your trading career. That's just a fact. Everyone does it. Anyone who doesn't own that is not being honest with themselves. Your goal is to make those mistakes smaller and smaller and to learn from them each time.
All right, Mike. Well, leave us with some final words of wisdom for all those new beginners out there.
Have fun. This is, invest in what you know. Look at what your friends are buying, what you're spending money on, and then could go pull up the chart and see what it looks like. Learn something about what the company is doing. Don't buy right before an earnings release, but keep it fun and keep it small and always learn every day. And I wish everyone the best of luck.
All right, Mike, thank you so much for helping us break down all of these golden rules of investing, I guess I should say, for those beginner investors out there and those who could use a little brushing up on their trading skills. We really appreciate it.
Thank you.
And after the break, we're sitting down with Nina Deka of ROBO Global to discuss the latest technological innovations in the healthcare sector and how investors can get exposure to some of the high growth names in that group with an ETF. That's next.
Good morning, everyone, and welcome to IBD Live.
Okay, here we go.
Now, between the ongoing race for coronavirus treatments and vaccines, as well as the rise of genomics and telehealth, stocks in the medical sector continue to demand attention. Here to help us break down the latest developments in this space is Nina Deka, Senior Research Analyst at ROBO Global. Thanks so much for joining us today, Nina.
Thank you for having me.
All right, so there are a lot of companies that are developing coronavirus vaccines, and you turn on the news or look at your computer and there are just headlines aplenty. It's all about that race for the vaccine. So very much in focus right now for investors in particular. So can you give us an overview of what you're seeing right now in the vaccine race?
Sure. Like you said, it's in every headline and it's a focus and it's very important because we do need a vaccine. And I do believe we're going to get there. And I believe it's going to be more than one company that gets us there. And they're probably, they're going to be very close in timing is what I imagine. So if not by the end of the year, by early next year, we should have, there's already 3 to 4 promising looking candidates based on phase 1 data. Couple that have already entered into phase 3, and they're doing multinational clinical trials with 30,000 people in some cases. So we caution investors in trying to just pick one winner and really look more toward the long term and look at what these individual companies are doing when looking to make investment decisions and use that as more of a guide in how to determine which companies you might want to bet on for the long term.
Yeah, because as you're alluding to, there's a lot of volatility with these stocks that's tied to that news, both positive and negative. So that makes it tough to pick the true winner there. But in addition to the vaccine race, let's talk about the genomic space and the contributions we're seeing there in terms of coronavirus therapeutic efforts.
Sure. So, I mean, one of the reasons why companies like Moderna were able to develop a vaccine to begin human trials so quickly was because they were able to sequence the genome of the virus and identify it from January. And that was done on Illumina sequencers. Illumina is one of the companies in the HTech Index, the Healthcare Technology and Innovation Index that we manage through research. And so Illumina is up 17% year to date. Last year, as of last year, they had over 15,000 sequencers placed around the world. And so they basically already laid the groundwork as gene sequencing pioneers that enabled us to accelerate the development of all these therapies and vaccine for the coronavirus. Another interesting company is Regeneron. They're not developing a vaccine per se, but they're working on genetic engineering technology, whereby they're using monoclonal antibodies to work on treating the coronavirus. And they're hoping to begin clinical trials this summer. And this is important because, again, this is an unprecedented pace as to how quickly they were able to develop an antibody cocktail to put into clinical trials. So really exciting things happening there. And it was, if you look at their history, it was the innovation that they had around past coronaviruses as well as Ebola that enabled them to get smarter and faster and learn more to help develop these therapies quickly. So when I'm looking at investing for the long term, I look at companies like Regeneron and Moderna, and I say, it's not what they're doing right now with coronavirus, it's what they've already done. You look at their rich pipeline, and these companies have a long runway for growth in many other therapeutic areas well beyond the coronavirus for a really long time.
Yeah, that's an interesting point that you bring up about the long term, because when it comes to these pandemic efforts, this isn't going to be a huge profit play here for a lot of these companies, right?
Not necessarily expected to be. And so that's why I would once again go back to the bigger picture. Moderna has over 20 other different therapies in clinical trials right now. This is a company that's pioneering mRNA therapy, which doesn't even exist on the commercial markets today. So any one mRNA therapy that gets approved is going to be a positive catalyst for the rest of the space. And Moderna's got over 20 other candidates in clinical trials. They're working on vaccines for Zika, CMV, RSV, and also HIV, which continues to have 1.8 million new infections per year, and there's still no vaccine for HIV. They're working on Zika. So all it takes is one to win, and for everyone to get excited about all the other therapies that are under development.
Mm-hmm. And elsewhere in the medical sector, due to social distancing, telehealth has of course been on the rise, and we've been following at IBD Teladoc very closely. What are your thoughts, speaking of profitability, on the path to profitability for a business like that? Teladoc, it's seeing huge sales right now, huge sales growth, but that's not necessarily translating to the bottom line as of this moment.
Well, the company continues to have increasing margin profile, which is interesting because 5-6 years ago, when the core business was predominantly general medical visits used to treat urgent care needs, the long-term prediction was that gross margins would decline over time as utilization went up, because the actual patient visits tend to have lower margins than the subscription revenue of this company. So what we're really saying here is that that trend didn't happen. They were able to maintain their margins, and the reason why is because they've invested in other areas like second opinions, for example. So people who have been diagnosed for cancer or need to get expensive surgery for some reason are given access through a service that Teladoc offers to contact another world-leading physician to review their records and see whether or not, in fact, they recommend getting this procedure done. So not only is Teladoc able to prove that they can save their clients money on fewer emergency room visits because they're able to, say, treat low acuity urgent care needs on a doctor visit, they're also able to save thousands of dollars in potentially reducing unnecessary surgical procedures. So they're branching into all of these other areas like behavioral health, dermatology, smoking cessation. And so when you look at all the growth opportunities across the board, their ability to drive value across more than one area is able to help sustain their margins over the long run.
Circling back to the beginning of our conversation and about picking winners in this broader space, especially when investors are trying to capitalize on perhaps the coronavirus efforts in particular, as well as these broader trends that you're talking about. The H-Tech ETF that you've mentioned has names like Quidel, Thermo Fisher, Intuitive Surgical among the top holdings. Those are a lot of names that we've been covering as well. And this is an index tracking ETF. Can you talk about that aspect a little bit?
Sure. So there's a couple of things that differentiate this ETF from some of the other ones on the market. And I think there's a lot of different ETFs for every different type of investor appetite. And what differentiates us is several things. First of all, we use research. We actually have a team of research analysts and also a strategic advisory board that is comprised of some of the foremost thought leaders across different areas of robotics, automation, and AI, that we tap into all these brains to put together what we believe is a proprietary set of subsectors. So when we look at healthcare, we're exclusively focused on healthcare technology and innovation. And so we developed a proprietary list of subsectors, the areas that we believe represent the next 10 years of disruption: genomics, robotics, precision medicine, telehealth, data analytics. And we look for the top number one, number two technological, market-leading, world-class players around the world. So it's not just US based. And so what you get as a result is a portfolio of companies in an index. There's about 80 or so that are diversified across these areas. And so if you look at H-Tech, it's up 25% year to date. When you compare that to other ETFs like XLV, which is up about 6% year to date, and truly a benchmark, what this is telling us is that there is a growing investor appetite for technology and innovation. And then when you invest in these areas that are across the different subsectors that I described, what you get is a portfolio that's more heavily weighed in small and mid-cap companies than your traditional standard ETF that tend to be cap driven. So I mentioned XLV and other strategies out there. They're great strategies, but they tend to be more heavily weighed in mature, stable, large cap pharmaceutical health insurance companies. And so those are great strategies for some investors, but ours is looking to meet the need of the investor that wants exposure to all of these high growth innovative areas over the next 5-10 years.
Yeah, well, there's a lot of innovation going on in that space right now. So Nina, thanks so much for coming on the show and breaking all of that down for us.
Thank you for having me.
And thank you all for watching this episode of Investing Strategies. For Investors Business Daily, I'm Alyssa Corum.